Exxon Mobil has just reported their earnings before the market opened. They are up around 0.39%. So is it undervalued? Was it a strong earnings report? And should we be adding to this massive oil giant? We're going to find out. We'll look at the historical performance. We'll look at their top line revenue growth year on year, their bottom line net income growth. We'll see how safe their balance sheet is, total cash versus total debt. We'll take a look to see how well they perform versus some of their well-known competitors in the industry. We'll take a look at insider buying and selling that we have seen some large amounts from the directors. And we'll see what the institutions are doing, more importantly, in the latest quarter, whether they've been buying or selling. And as always, we will look at that dividend safety. We'll look at their financial metrics to see whether or not this is a company we should be investing in. And we'll touch upon that all-important earnings report that they had to see if they are moving in the right direction. And as always, we will run them through the valuation model, getting to the intrinsic value as well as the acceptable buy price given our investor margin of safety, taking a look as well as what Wall Street are forecasting over the next 12 months. So let's start off with their earnings report. Now the headline reads that Exxon Mobil beat earnings expectations even as lower oil prices weighs on their profits. So we'll look at their numbers, but we can see they did beat their earnings per share. However, revenue did fall short. But we also like to note that the quarterly profit did decline significantly from the same period a year ago due to oil demand weakening. And we can see that they did produce a significant amount of barrels per day in 2023, largely flat, however, in comparison to the prior year. So when we look at the numbers, first thing to note, as we mentioned, they did beat on the earnings per share, 248 versus 221 expected. Revenue did come under 84.3 billion versus 85.2 billion expected. Now we can see it has cooled off slightly. It was up over 1% in the pre-market trading. It is now around 0.4%. And they have declared a dividend of 90 cents, or 95 cents in fact, per share payable. So let's take a look. It is interesting to note that they do pay a lot in dividends, 14.9 in 2023, and a lot in those share buybacks, 17.4 billion. So they are returning a lot of cash to investors one way or another. Over the last year, well, down 11%. And if you've been holding this company over the last 10 years, you'd be up 13%. Bear in mind, though, it doesn't include those dividends reinvested. Now we see it is towards the mid to lower end of the 52-week range. It does offer a yield of 3.71%, and we can see a forward PE of 11. So in terms of their top line, what we like to see, 3 to 7% growth year on year, 281 billion in 2018, 402 billion in 2022, and as we read in the report there, 350 billion expected for the full year, and it is a decrease from the prior year. So we do note that with this industry, oil and gas, it is very cyclical, it is volatile, so this is expected. So we note a decrease to 2019 and again to 2020 before picking back up in 21 and 2022, and then we see it drop. So something just to bear in mind with this industry as we run through the metrics as well. It is very cyclical. We won't see constant increases year on year. 21 billion reported bottom line in 2018. 56 billion reported in 2022, so more than double increase to their bottom line. Again, it is expected to drop in that prior year comparison, 41 billion versus 55, but we also note the inconsistencies year on year. Again, it's very important to understand that this industry is very cyclical. If you understand that, then that is completely fine. Total cash and short-term investments in 2018, 3 billion, and we can see in the latest quarterly report a large increase, in fact more than 10 times to 33 billion. How does that compare then to their total debt numerically and directionally? Well, what we can see, it has gone from 38 billion to 41 billion. So yes, total debt has increased, but at a much slower rate than their total cash. So it is positive to note, and we will shortly look at the essential net debt to EBITDA metric that relates to the dividend safety. Oil and gas industry then, we have competitors such as Chevron Corporation, Shell, Total Energies, BP and a few others. So over the last year we do see Exxon Mobil down 8%. Now it does include those dividends reinvested. It is one of the worst performing, pretty much there in line with Chevron Corporation. Now when we extend that to the last 5 years, we see Exxon Mobil in fact the best performing, up 77%. Not too bad for the last 5 years, but as always, just keep in mind past performance isn't an indicator for future performance. Quick look through the screener, insider buying, insider selling over the last 3 months. Well, the director actually bought around 26 million worth of shares in November last year, but we do note that only a few weeks later he did sell and sold a lot more for 216 million, and we do note that he did sell at a higher price than today. Now, one thing to bear in mind, yes, insider buying, yes, insider selling. What I would point out, yes, insider buying is a bullish signal. It means insiders buy because they believe the share price is to go up. But we know that Jeffrey, in fact, sold quite a lot more than he had initially bought. So I would say take that with a pinch of salt, because insider selling we typically believe isn't a bearish signal, and it can be to personal or financial reasons. Institutional ownership, well, 58%, 22 billion worth of sales by these institutions over the last 12 months. The same period, a lot more buying, 150 billion worth. Now, the largest buy did come in Q2 of around 117 billion, and we do note in Q3 and Q4 that there was more buying, well, in the more recent period of Q4, with Q3 a little bit more selling than buys. Always bear in mind, we like to use this information in our analysis as we gather the data, but realistically we should always be doing our own due diligence. Dividend safety score 80, market cap 409 billion. It is a mega cap company. Now, the last recession, 07-09, they in fact increased the dividend. They had below average growth of negative 40%, but they did significantly outperform the S&P, negative 28 to the S&P's negative 55. Now, we're expecting a dividend increase in October of this year. In fact, 4.4% was the latest increase. Pretty mediocre in my opinion. That is pretty much just in line with inflation. Last 5 years, a little bit lower than what we like to see. Last 20 years, something we would like to see moving forwards around that 7%. And when we do cover Chevron Corporation, they in fact today did increase that dividend by around 8%. Now, in terms of Exxon Mobil, they have been increasing those dividends for the last 40 years. They are a dividend aristocrat, and we can see they have been paying dividends for the last 141 years without a reduction. An absolutely phenomenal metric there. Now, dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. Right now, we have a sign of overvaluation, but it's important to remember we're not looking at any of these models in isolation, and we will draw our conclusions towards the end. We can then see the forward PE, it is 12, pretty much in line with the 5-year average of 12.1. And we can see the energy sector PE is just a little bit higher at 12.4. So let's take a look at the free cash flow payout. We ignore earnings susceptible to manipulation by management through accounting. Below 40%, you can target that for oil producers. For me, below 60 as a blanket rule, it does give me then personal faith that management are able to offer those double-digit increases. 2021, 2022 and 2023 pretty much below that 40% level. We do see 41 in 2021, but other than that, looking pretty strong. So we would like to see a nice increase this October. 254 free cash flow per share, 1390 in 2022. It is expected to drop in 2023. But yes, it does increase over the period, but again, inconsistency, and a lot of that will be derived from the cyclicality and volatility of the industry, which is shown here. We can see years of negative growth followed by double-digit growth and so on. It is very, very cyclical, and you can see that numerically in terms of total sales. They also do share buybacks. They do return excess cash to investor pockets. They have bought back just under 400 million worth of shares over the period, 4.42 billion to 4.08. Now, in terms of the ROIC, I personally like to see 10% or more. That gives me faith management are able to effectively allocate their capital. The last 3 years, it has been above that 10%. Nice to see that 2023 at 19%. Margins, again, this is essentially the volatility of the industry. We don't see very consistent year on year. Although if we just want to look at the more recent period, we can gain some satisfaction that it is around that 10 to 18%. And the same can be said for the free cash flow margin. Net debt to EBITDA, earnings before interest, tax, depreciation, and amortization, shows us the balance sheet strength as well as dividend safety. 2022, it would take them 0.2 years to pay off all of their debt net of cash on hand. 2023, 0.15 years to pay off all of their debt net of cash on hand. Very strong balance sheet. The dividend does look to be safe based on this information. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So let's jump into the first model, Graham's valuation. We have the earnings per share, the long-term growth rate, and the AAA corporate bond yield of 4.57. giving us an intrinsic value showing severe signs of undervaluation as we can see in comparison to the market value. Do bear in mind though, we don't look at any of these models in isolation. We then have the multiples valuation model, the average P of their competitors multiplied by the earnings per share of Exxon. Slightly overvalued as we see the intrinsic value come below that market price. We then move on to the dividend discount model. Now the growth rate has been a bit mediocre over the last 5 years. Forward looking, I've gone for what I believe to be reasonable. It is slightly lower than the latest increase, but moving forward, I do want to see a minimum inflationary increase to that dividend. Therefore, we get an undervaluation signal, but do note it isn't too far off the current trading value. We then move on to the DCF model with the free cash flow year on year. Growth rate, we've gone in line with analyst estimates at -6%. In line with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We can see there that undervaluation, severe sign in fact, on the DCF model. So the intrinsic value in today's episode is the average of these four models that you can see on screen, and today it comes to $130. Now, as always, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, then do click on that pinned comment below. Now, we start off with 10%. Now, we use this if we believe it has a wide moat, strong financial metrics, good forward-looking data, and we can keep going until it comes towards the current trading price. So we see around 20% margin of safety up to $104. Now, what do Wall Street forecast? Well, they see some significant upside to this company. We can see, in fact, 25% with a price target of $128 over the 12-month period. As always, though, do let me know your thoughts in the comments below. Is Exxon Mobil a company you're looking to add? Maybe you're a shareholder. Did you like the earnings report? Are you looking to buy more? Or maybe you are waiting for it to come down lower than even the 52-week low that we saw not even that long ago. As always, if you enjoy the content, smash that like button, hit the subscribe and bell button, and as always, I'll see you on the next one.